Hello, everyone. Welcome to Finance Friday. I'm Hard Money Jim, investigating money creation and its consequences. So we're back in Southern California again this Friday, where gas prices here on my little island of Coronado near San Diego are right near $7 a gallon. Rising gas prices are just one of the obvious consequences of excessive money creation, as all consumers are rising on the back of this extraordinary money creation by the banks and the Fed that we saw during the coronavirus pandemic. I don't know when gas prices are going to top out or moderate, but some good analysis that I've seen indicates that oil prices might go as high as $130 to $180 a gallon before there's any actual reduction in demand, in quantity demanded. $130 to $180 a barrel, I should say, and the price now is around $115 to $120. And of course, the price of crude oil is just passed through to the price of gasoline. So we'll just have to wait and see. By the way, I am old enough to remember when I was in Air Force pilot training back in Laredo, Texas in 1971. And gas prices then were 23 cents per gallon. Think about that. I ask you, what has changed in that 50 years? The money or the oil? The oil is still the same. That's 50 years of inflation for you. Anyway, today I want to do two things. First, I want to update you on the state of inflation in the USA, inflation's effect on consumer prices and on the public's general attitude toward inflation in the country. And we're going to see that both the facts about consumer prices and the level of public concern in the country have gotten worse since we spoke about 3 weeks ago. So I'll just say in advance, I really don't have any great news about inflation today. Excuse me, got a little froggy throat I got to take care of here. All right, well, then after that inflation update, I want to dive into a question, a problem that many people have asked about. And that question is, I and many others claim that across the board price increases, what some call inflation, that this is caused by an undue increase in the money supply, which in turn is caused by government policy or government action. In fact, I say inflation properly defined is an undue increase in the money supply caused by government. And that's the cause of CPI inflation. But there's an apparent statistical problem with that claim. We had very high money supply growth for years between 2010 and 2020 before we ever got any significant increases in consumer prices. So for years, this money supply increase did not show up in consumer prices to the extent that one would have expected. Now, why was that? How could that happen? How could we have had rapid money supply growth and along with fairly low consumer price inflation for so many years between 2010 and 2020? So today I'm going to take a stab at explaining that, and I hope you'll find my explanation helpful. Okay, so first, let's do an update on headline inflation, the number that everybody talks about, the consumer price index. Here's the standard chart I usually show updated. The current annual rate of increase in consumer prices on the far right is on the far right. It just hit a 40-year high of 8.6%. Up from April's 8.3%. Most of the commentators, you probably have heard by now, were expecting inflation to peak and moderate a little bit. 8.2% was the consensus number. And most of the talking heads that I read and listen to were surprised that inflation, consumer inflation actually got worse. So just how bad is this in consumer price inflation? It actually might even be worse than this chart shows. Larry Summers, the former Treasury Secretary under Bill Clinton and now an influential economist at Harvard, has reconstructed consumer price inflation using the same methods that were used back in the 1980s, before the government altered its calculating methods to account for product quality and substitution effects. Summers calls his calculation, quote, a constant methodology synthetic CPI. And this constant method measurement says that consumer price inflation today, if it was measured as it used to be, set a high in, it is higher than its all-time high in March 1980 of 11.4%. So if we measured, in other words, if we measured inflation like we used to back in the 80s, inflation is higher now than it was even in the worst year of the 70s and 80s. Think about that. Now, then there's the question of what the public thinks of inflation. They are more concerned than they've ever been, really. We need to remember that the Fed has two missions, a twofold mission, really, as defined by Congress. The Fed's two objectives are to maintain full employment and to maintain stable prices. So it's unemployment and inflation that they're primarily concerned about. Unemployment, when it rises, affects a small percentage of people. It's unfortunate for those people affected, but when unemployment goes from, say, 4% to 8%, only 4% of the people are affected. But consumer price inflation, which is loss of purchasing power, affects everyone, from Bill Gates to welfare recipients and everyone in between. It affects everyone. That's why I have repeatedly said that inflation is a political hot potato like no other, and average citizens are very concerned about it. Now, here is the University of Michigan Consumer Confidence Index. It goes back 70 years. Last Friday, June 10th, this measure hit its lowest level in its 70-year history. So the lowest consumer confidence level in history wasn't after 9/11 or on the dot-com crash or due to the great financial crisis or any of the many wars that we've been involved in. The worst day for consumer confidence was last Friday, June 10th, when CPI surprised everybody and came in at 8.6%. That's an indication of how serious consumer price inflation is to people, and why it's top of mind in all the surveys when people are asked about their concerns about in the country and the economy. Their concerns are not about climate change or the border or the Capitol riot or the Ukraine war near as much is their concern about their cost of living going up. And all the surveys, some of which I've cited in the past, confirm this. There's also evidence that even higher earners, especially those in the millennial group, are feeling pretty vulnerable to consumer price inflation. One survey says that 63% of millennials, those are people born between 1981 and 1996, earning up to $150,000 a year, which is pretty good, are living paycheck to paycheck. They don't have much wiggle room, really, except to cut back on their expenses. So if you need another measure of economic hardship on the middle class, then take a look at the monthly cost of servicing a mortgage for the first-time home buyer. That's now at an all-time high due to sharply higher mortgage rates that have just gone up to around 6%. Okay, and now in addition, according to researchers out of the Atlanta Federal Reserve Bank, inflation is becoming more entrenched in consumer prices, and it's looking more and more like it's here to stay for a while. Researchers there at Atlanta, at the Atlanta Fed, divide the elements of the CPI into flexible prices and sticky prices. The so-called sticky prices are the items whose prices respond more slowly but persistently over time within the CPI index. And these are items like shelter costs, utilities, public transportation, insurance, and so on. And you can see from the Atlanta Fed's chart here that the sticky price contribution to CPI, the things that are in orange, are rising rapidly since 2021. Sticky prices now account for almost 4% of the CPI increase. That's up from 1% 18 months ago. So they now account, these more permanent prices now account for nearly half of the headline's 8.6% number. So the point about this is this consumer inflation that we're in does not appear to be a temporary flash of volatile, flexible prices or like food and energy. It appears to be more entrenched and more embedded in the economy, and it appears that it will be with us for a while. And if you want to look at the stickiest prices of all, those are in shelter costs. And here we can see the difference between the new rental rates that are as reported by the real estate company Zillow and what the government CPI numbers say. Given the 6-month lag between new rental rates and when they're expected to be reported to the CPI, I think you're going to see CPI shelter costs continue to rise a lot more in the coming months. Other surveys show future inflation expectations are up both among consumers and investors, indicating that the so-called transitory argument, the thought that consumer inflation will soon moderate, is now largely gone, and people are realizing and accepting that consumer inflation is more or less a fact of life. The market reaction to this increase in the CPI has been to sell everything from stocks to bonds to crypto and even precious metals. Everything's being liquidated. Although gold and silver so far are down less than the most other assets, in general, though, virtually all investments are selling off. And one last point I should make is that our government's reaction, in the US at least, to this inflation problem continues to be what I would have to call clownish denial. It's not helpful because it's not credible. Joe Biden has repeatedly referred to the current inflation as Putin's price hike. And in fact, the price pressures caused by the Ukraine war are very minor in the total scheme of things. For example, if you want to know why gas prices are high, here's one good reason. This is the drilling rig count in the USA. Now, high fuel prices like we have now should generate a supply response, but our energy industry is not being allowed to drill for fossil fuels. The US rig count is a fraction of what it was a few years ago. We're simply not exploring enough for new oil and gas, and the reasons are all because of government restriction. In addition, gasoline refinery capacity is down to its lowest level in many years, despite the growing demand. Now, we've not significantly added to refinery capacity in this country since the 1970s. But that is obviously not the fault of Vladimir Putin. So don't be fooled by that claim. Okay, that is, I think, enough of an inflation update. Let's pause here for some super chat comments or questions if we have any, before we get on to the main question of the day. Daniel, do we have anything to talk about?
No questions, but I'd like to thank Bonnie for her super chat.
Oh, I will also thank Bonnie for that. Thank you, a loyal and regular contributor. Okay, so the next question we want to ask is, the main question of the day, is why did inflation take so long to get here? Consumer price inflation. It seemed to come at us suddenly, almost out of nowhere. We had years, or what you're seeing here is money supply growth in the USA, M2, rate of growth. So we had years of high money supply growth, an average of 8% annually from 2010 to 2020 before the big supply explosion shown on the right side of the chart. But if you look between 2010 and 2020, that average is about 8%, which is actually very high. But all this time, consumer prices stayed pretty subdued. How could the Fed pump money at the economy for so many years without causing some kind of troublesome increase in consumer prices? Now, there are consumer prices, and if you look carefully, for all those years, they're rocking along at between 1 and 2.5%, maybe up to 3% for short periods. Now, the big thought question we want to answer today is, why did this terrible consumer price inflation that we're in now seem to appear all of a sudden out of nowhere? I am going to offer two reasons: a monetary reason and an economic reason. But before we get into that, let's first review the Fed's definition of inflation. The Fed says, quote, inflation is simply an increase in consumer prices, what you're seeing on this chart. So to them, it's an upward movement of an index consumer price. It's a statistic to them. So here I'm showing the CPI. The Fed uses a slightly different measure, what they call the PCE deflator, but it's very close to the CPI. So this is illustrated. Now, some people, me included, say this policy of 2% inflation is fraudulent because the Fed's mission is to provide both stable prices and low unemployment. Yet they define a built-in 2% inflation as, quote, stable prices. Why is 2% their goal? Where did they get this 2% inflation goal? And I finally found the answer to this question by reading an interview with Judy Shelton, who's a conservative economist and a former Trump advisor and has been around the block a long time. The story that she told was that back in 1996, Janet Yellen, the current Treasury Secretary, convinced Alan Greenspan, who was then the Fed chair, that targeting consumer inflation at 2% was a good idea. And that idea apparently came from Janet Yellen's husband, the economist and Georgetown professor, George Akerlof. Now, their rationale for this was that a 2% annual increase in wages and prices is low enough that most people will not be concerned about it. 2% they thought is low enough to avoid a massive inflation mindset or strong inflation psychology. If people don't care, it's not really inflation, or so they think. So these economists also think that the public is psychologically very averse to declining wages. They think a pay cut will cause major unrest among labor unions and other labor advocates. So very simply, no one likes a pay cut, especially during a recession. So just imagine your wages are increasing nominally at 3% a year, 3%, let's say. But the Fed depreciates your money at 2% a year. So you're only getting a 1% real annual increase. Then along comes the economic downturn, and wages only go up 1% nominally. But inflation is 2%. So even though you've really lost 1% in real terms, the Fed thinks you won't notice because they think you don't care, or that you still have more money this year in nominal terms than you had last year. You didn't take a pay cut. It's a psychological gambit, and it's an example of what a lot of people call the money illusion, where people just think that because they're getting the same amount of money, same amount of dollars, they still have as much purchasing power as before, even though they've lost a lot of purchasing power. So, just for fun, let's take a closer look at the Fed's notion of low inflation. Using CPI as a measure, $100 that you obtained back in 2000, if you still had it in your pocket, would buy goods worth $57.80 today, based on the consumer price index changes. Now, the point of this little diversion into the Fed's bizarre definition of, quote, no inflation or stable prices is that the very notion that there was, no consumer inflation for years was a lie. Inflation was always there. Consumer inflation was always there, wearing away the value of your dollar. It's just the Fed didn't want you to notice. Apparently, they think that we, the people, are like frogs in a pot that's slowly heating up, right? We won't notice a 2% decline in purchasing power, even though over time it hurts lots of people. Instead, we're just going to relax in that pot called currency devaluation. And when the downturn comes, we'll believe it didn't get worse because nominal wages didn't go down. So that's the Fed's measure of inflation. It's, first of all, deceptive because it claims real monetary depreciation of 2% annually is not really currency depreciation. It's not really even inflation, they say. But it's even worse than that because consumer prices, as we've said on this forum before, do not measure some of the important things that you spend your money on. CPI increases can be low, but other costs can be inflating very rapidly. And the Fed will still claim that there's no inflation. Now, prime example of this is the cost of acquiring assets for saving. To provide for your future, you probably want to buy a house or own stocks or bonds or just open a normal savings account and put away some money every month out of your paycheck. But stocks and bonds and house prices and savings accounts are not in the CPI. If you look at the list of items in the CPI, you will find no entries that reflect the cost of saving for your future or the cost of buying a house or the cost of buying shares in your 401k. These are things you need to spend your money on, but they're not on the CPI list. And you, lowly consumer, are not supposed to consider asset price inflation as important to your regular cost of living. However, in fact, you should be concerned if you're a rational person preparing for your future. But because of the Fed's asset bubbles, asset prices are so high that it's going to take you 3 times more money per month than it used to build a nest egg. So I say we have had inflation for a long time, but it's just been much more evident in assets and less evident in consumer prices. But now we should answer, why was this? So after that long introduction to my big question, let's first take a look at what asset prices did during the QE, quantitative easing years. Since QE started in late 2010, asset prices have soared, but consumer prices have been fairly subdued. During that same period, real GDP, a measure of real physical production, grew by about 2.3% per year. Nominal GDP grew nearly twice that rate, about 4.5% annually. But nominal GDP and money supply are normally closely connected. So you would have expected nominal GDP growth to be much closer to the 8% annual increase in the money supply. Clearly, most of that new money pouring into the economy from 2010 to 2020 was not fueling GDP activity or CPI activity. So where was all that money going? Well, much of it went to the stock market and the bond market and the housing market. In the 10 years of 2010 to 2020, stocks shown here, the S&P 500, went up 250%. And they went up, that's just till 2020. And then they went up another 70% from 2020 to 2022 in what I call pandemic QE. Now, lots of that money also went into the housing market. This is median house prices in the United States. House prices went up 33% during the first 10 years of QE and another 35% during the 2 years of pandemic QE. Overall, in the full 12 years of quantitative easing, 2010 to 2022, here are the relevant numbers. M2 money supply increased 149%. That growth was 8% per year until it exploded in 2021 and 2022 for an average annual growth over that entire 12-year period of 12%. The consumer price index went up 27.5%, and half of that rise came in the last 18 months, along with the upward explosion in money. The S&P 500 S&P 500 index increased 275%, and that's even after the recent 23, 4, 5% sell-off that we've had. We're obviously in a bear market in the stock market these days. The median house price increased 77%, and the gold price increased 60%. So clearly, you won if you owned assets, and you lost if you held cash. And I want to explain why this asset inflation happened. And I say it was mainly due to quantitative easing, pure new money creation that was directed more toward asset purchases than it was at consumer goods. And to see how this works, we first have to get clear on why the price of anything should rise. So to explain that, I want to use my standard cigar store example to explain. So suppose consumers at my local cigar store spend $5,000 a week to buy 500 cigars per week. That's an average of $10 per cigar. Now, it is mathematically required that if the average price depends on the demand, in this case, $5,000, divided by the supply, 500 cigars. So if in the first week customers buy 500 cigars per week and spend $5,000, the average price is $10 per cigar, 5,000 divided by 500. If in the second week customers bring more money into the store and they spend $10,000, the average price will go to $20 per cigar. Furthermore, if the price is going to continue to rise further after that, this is going to require even more new money to be spent at the cigar store in subsequent weeks. So assuming the volume of cigars sold does not decline, the only way for prices to keep continually rising is if new money is continually spent in the cigar store. More money than was spent in the previous period. If the same money is spent on the same number of cigars, the average price cannot rise. Now, that's the same for share prices in the stock market. If share prices keep rising on equal or rising share volume, it must be true that more money was spent on stocks to create those higher prices. It's the same with house prices. If the volume of home sales stays equal or increases, and house prices keep going up, the only way for this to happen is if more money is spent in the housing market in each successive period. And it's the same with all markets. Butter, eggs, Beanie Babies, you name it. The number of units, if the number of units is not declining, the number of units sold, and more money is being spent on those units in question, you can only get higher prices. So for stocks and house prices to continue to rise, clearly there was a continuing flow of additional new money flowing into the stock market and into the housing market. So now let's explore the major source of that new money that was entering these markets, which, as I say, was due to quantitative easing done both by the banking system and the Fed. Both are required to do QE. And as we'll see, both are required, and that's important. First, let's recall what QE, quantitative easing, is. It's a joint operation by the commercial banks and the central bank. The Fed is the example I'm using in this case. It could be any central bank, to create new money. First, money is created in the form of a bank deposit by commercial banks when they buy bonds. Next, those bonds are bought from the bank by the Fed and paid for with new bank reserves. So the result of QE is that both new money, broad money in the USA called M2, in the form of bank deposits is created, and New reserves are created when the Fed takes possession of those bonds. Now, usually these transactions, the bank purchase and then the Fed purchase, are done simultaneously. The overall effect is that the Fed uses the banks as a pass-through entity to buy the bonds. So here is a quote from a very good paper, important paper in the bank, from the Bank of England, which I encourage you to read if you have a further interest in this. So it's talking about when the central bank thinks that money creation is too slow down in the banking sector. It says one possible response is to undertake a series of asset purchases or quantitative easing. QE is intended to boost the amount of money in the economy directly by purchasing assets, mainly from non-bank financial companies. QE initially increases the amount of bank deposits those companies hold in place of the asset they sell. Those companies will then wish to rebalance their portfolios by buying higher yielding securities, raising the price of those assets, and stimulating spending in the economy. As a byproduct of QE, new central bank reserves are created, but these are not an important part of the transmission mechanism. This article explains, this article I'm quoting here, explains how, just as in normal times, these reserves cannot be multiplied into more loans and deposits, and how these reserves do not represent free money for banks. Now, many economists, even famous ones, make the mistake of saying that QE creates only new bank reserves, but not new spendable money. This is both incorrect. This is incorrect, and the error here has caused a lot of misunderstanding. The fact is, QE always produces both new spendable money and new bank reserves. And now, just so you don't think that either I or the Bank of England are making this up, I want to read you another quote, this time from a US Federal Reserve publication. The author, who's a Fed economist, is describing standard open market operations, which are operationally the same as QE, except they're done on a much, much smaller scale. But the mechanics are identical. Quote, when the Federal Reserve wants to increase bank reserves, it contacts dealers or financial institutions that are willing to sell their government securities. In exchange for the securities, the Federal Reserve credits the financial institution's commercial bank with additional bank reserves equal to the value of the securities. The commercial bank in turn credits the institution's account. And here is the key passage. The net result is that the Federal Reserve has more government securities, the commercial bank has larger reserves, and the dealer has larger deposits with the commercial bank. Both bank reserves and the money stock have increased by an equal amount. That is from a gentleman named Scott Hine, Federal Reserve Bank of St. Louis, from way back in 1981. So I hope you're getting this, but to hammer the point home, I want to visually now follow a QE transaction so you can see how it works. This diagram is from the Bank of England's quarterly bulletin, Q1 2014. It's the same article I quoted earlier. Now we're going to look at the assets and liabilities of three entities. Let me check my time here. We're good. We're going to look at the assets and the liabilities of three entities. The first entity is a pension fund, that's on the top row, that owns a government bond. And that bond is labeled government debt, upper left. Now, instead of a pension fund, this could be any institution that owns government bonds, any so-called saving institution, such as, a mutual fund or a hedge fund or an insurance company or a brokerage company, or any other non-bank entity, okay? Now, the second entity in this transaction is the central bank, which has, you see on the left, it has various other assets and liabilities being reserves. The third entity is the commercial bank, with bank reserves as assets and liabilities in the form of bank deposits or money. The money, which again is a bank deposit and a bank liability, is shown in the red boxes. Reserves or deposits at the Fed are in green. On the left side of the diagram are the assets and liabilities of each of these three entities before QE. See, before asset purchase. And on the right side are their assets and liabilities after QE. So let's start at the top with a pension fund that owns a treasury bond labeled, again, government debt. Let's say the Fed is not happy with the amount of money the banks are creating through lending, so it decides to take matters into its own hands. The Fed contacts the pension fund and offers to buy the bond, and the pension fund agrees. The Fed directs the commercial bank, which it regulates, to purchase the bond from the pension fund. The bank completes the purchase, paying for it with a new bank deposit. This creates a deposit in the pension fund's bank account, creating new spendable money that did not exist before. This is the moment of new money creation. The banks do it. This new bank deposit is now an asset, it's cash, of the pension fund and a liability of the commercial bank. The central bank then immediately buys the bond from the bank, paying the bank with new reserves. Now, under QE, this central bank transaction is simultaneous with the commercial bank purchase, which is why the government bond does not show up on the commercial bank's asset account. If the bank had bought the bond from the pension fund on day one, and then the Fed had bought the bond from the bank on day two, the bond would show up as an asset of the bank on day one, and then the bond would be replaced by a new bank reserve on day two. But when the entire transaction is done simultaneously, new bank reserves become both an asset of the commercial bank and a liability of the central bank. I hope you follow that. If you don't, go back. I'm going to provide a transcript of this talk, and you can go back and check this out and think about it. What is happening here is the central bank is providing a new source of demand for bonds, which tends to raise bond prices and lower market interest rates. The pension fund now, after this, has new money to spend instead of an interest-bearing bond to collect interest on. So the pension fund must now look for a replacement investment. After all, it has to earn interest to meet its obligations to its pensioners. So now let's think, what will that pension fund do with this new chunk of money? What would any savings institution do with it? Those savings institutions, pension funds, mutual funds, hedge funds, etc., they don't buy butter or eggs or cars. They buy financial assets, mostly stocks and bonds, as investments. Hedge funds are now even buying up single-family homes in bulk, and they're doing this with new money. When the price of their investment rises and is sold, then they buy more investments at higher prices, which they can do because the Fed balance sheet, as the Fed balance sheet expands, these institutions are regularly getting new additional money, so asset prices keep rising. So there it is. New money has entered the investment market, just like new money that entered our cigar store. When the banks and the Fed engage in this activity on a sustained basis over many years, they build up a huge new source of demand in the stock market that was never there before. So how much money, new money, was directed into the stock market and the bond market in this way? Well, let's just look at the Fed's purchase of Treasury securities over time. This graph shows the Fed's holdings of U.S. Treasuries, and just look at the jump in 2010, 2012, 2014, and of course the big push in 2020. Every dollar the Fed spent on Treasuries was matched by new money in the commercial banking system. That's M2, or broad money. Most of it injected into the investment markets. In 2010, the Fed held less than $1 trillion in Treasury bonds. Today, they own nearly $6 trillion, or nearly $5 trillion increase. And most of this $5 trillion increase represents new money sloshing around in the investment markets. And the Fed bought a lot more than treasuries. It also bought mortgage-backed bonds. The only time the new QE money leaks out into the public spending that would affect the CPI is through things like higher salaries for the pension employees or in distributions paid to the pensioners, which will then be spent on CPI items. But these are only a fraction of the pension's asset value every year. Some of the gains are spent on, on super yachts or large private jets, or, large land holdings. But most of the new money stays in the investment world, where the participants use that new money to purchase investment assets, continually raising asset prices and lowering interest rates. So now we can begin to see why this new source of money stayed mostly in the investment markets and raised asset prices. And why it did not immediately leak out into commodities and consumer goods in the form of soaring consumer prices. So let's look at another money transmission mechanism, in this case, house prices, through the mortgage-backed securities market. Here, whoops, there it is. There is the mortgage, this is the graph of the Fed's holdings of mortgage-backed securities. So works the same way. Banks create new money when they lend you money for a house. The banks then aggregate these loans and they sell them to Freddie Mac and Fannie Mae, who pool those into a fund and then issue bonds based on that pool of mortgages. And this is all done to mitigate the risk of owning individual mortgage loans. And this so far is a good system. But next, various savings institutions invest large amounts of money into those mortgage pools. And then now the Fed steps in, purchasing large quantities of these mortgage-backed bonds, creating new money in the QE process, just like they do when they buy treasuries. The extra demand drives mortgage interest rates down. The Fed purchase program takes those bonds out of the market, creating an appetite for more new mortgage-backed bonds, more mortgages than ever before at lower rates. And this increasing supply of mortgage money at lower rates causes homeowners to bid up the price of houses, which they can easily afford to do as long as interest rates stay very low. New mortgage loan formation, that is new money creation, is a very lucrative business for banks. So they keep creating more loans, that is creating more money, knowing they can offload those loans to the Fed at a profit, setting them up to repeat the process again and again. These loans carry very little risk of default because of government guarantees and the Fed's willingness to buy these loans. So this is how demand for homes keeps rising. It's because of the continual creation of new money used to buy homes, new money that enters the housing market. This is the only explanation I know that can explain the meteoric rise of house prices across the country over the last few years. Now let's return to the CPI for a moment. Its components are shown here. I hope you can read them. About 70% of GDP is transactions that count only the personal consumption of goods and services. That's basically the same items that are in the CPI. Food, fuel, shelter costs, medical care, and so forth. When you think about the new money being spent on financial investments, as I've just described, is any of that new money going into these CPI items? I would say practically none. Look at the list. When you buy a home, or when you or any institution, when you or any institution purchases stocks or bonds, those transactions are not counted in the CPI or the GDP, so they will not bid up the prices in the CPI. So for years, the prices of items in the GDP and the CPI were not being affected near to the extent as the investment markets because of the amount of new money entering the CPI and new money being spent on the CPI and new money being spent on GDP items was much less than the amount of money entering the investment markets. So, during this period, the last 10 to 12 years. The Fed says rising asset prices was not, quote, inflation. Yet the cost of saving is skyrocketing as you now have to spend more to acquire a nest egg because interest rates are so low. And eggs and cheese stayed cheap, but saving for your future became almost impossible unless you speculated in the stock market. Does that sound like a no inflation environment? Well, only I would say if you have a very narrow and strange idea of what inflation is. So the point is, we had a lot of inflation during the QE years. It did not show up very much in consumer goods, but it was very evident in the investment markets. There were a few CPI items where you did see some price inflation. For example, look at the cost of college tuition, which is a very small part of the CPI. College tuition has risen at about 3 times the average rate of increase in the CPI. Can you guess why? So if you want, go ahead and enter your answer on the chat space. The question is, why would you say college tuition went up at more than double the rate of the CPI inflation between, say, 2008 and 2020? Now, if you guessed that college tuition rose because lots of new money was entering the market for college tuition, you've been paying attention and you get an A for class participation. So this is the growth you're seeing here of student loans during that period, 2010 to 2022. Student loans almost tripled during that period. Most of this lending was done by the banks, supported by government guarantees, rather than by the Fed's and rather than by the Fed's QE program. This didn't have anything to do with QE, but there was a lot of money creation guaranteed by the government. What you see in the graph is mostly new money being thrown at colleges, raising the demand for their services and driving up tuition prices. Did the population triple? Did the number of students triple? Of course not. There's no physical tripling of demand. Public policy just threw money at colleges with predictable increase in college costs. All right, so there is my explanation as to why we have seen until very recently lots of asset price inflation, but much less consumer price inflation. It was largely a monetary factor. I hope you can see now why this new source of money from QE stayed mostly in the investment markets and raised asset prices and did not immediately leak out into the commodity markets or consumer markets in the form of soaring prices. Now, I should say, I'm going to run out of time here, but I should say that there was likely an additional non-monetary factor that helped consumer prices stay low. And that factor was actually a very positive economic factor. It was a surge in real productivity due to improved internet communications, international specialization of labor, cheap foreign labor, and so forth. Online communications gave us Amazon, online car sales, better information, more efficient supply chains, all the things you know about, inexpensive foreign labor, and an expanding workforce. Think China, Southeast Asia, India, et cetera, gave us much cheaper goods. This kept consumer prices from rising too fast. I say that without monetary expansion, consumer prices would likely have declined as they did in other periods of great productivity, like the late 19th century. So I think the Fed tricked itself into thinking that inflation is solely consumer price increases. The slow rise in consumer prices, which was mistaken for, quote, no inflation, caused the Fed to think they could get away with money printing indefinitely without inflation, when all the time asset price inflation was going on right under their noses. So the fact is, we do live in an inflationary world. We've lived there for many years. Inflation did not just emerge in July of 2021, despite the Fed's being surprised about it, and their claims that CPI inflation was transitory. Inflation's been with us, hiding in plain sight for many years. It's just that the price increases didn't show up in consumer prices till recently. Now, the damage done to the working class went unnoticed for a long time because for a while they did okay. The working class, middle class stagnated, or they got ahead, slowly. But at least for all these years of QE, they could afford eggs and cheese. But now things have changed. Lots of new money has now been spent on consumer goods, and we have consumer price inflation coming out of our ears. So I'll just tee up for a later conversation. What changed? How did new money get injected into the consumer markets? Well, I'm running out of time today, so I have to draw a line here, and we'll save for a later day a discussion of how new money finally found its way into consumer prices, causing the big inflation panic of today. Okay, let's draw a line there. And if there's any questions or chats to acknowledge, bring them on.
Yes, we have a super chat from Michael. He says, a little behind in attendance, but excited to catch up.
Wow, I'm excited to have you. And I'm going to post this. I guess you'll have it on the YouTube channel. But as I said, I'm going to post what amounts to a transcript on this. I've gotten some requests for these on my Substack page. So if you want to read what has been said today, or examine the charts a little more, you'll be able to do that. So thank you, Michael.
And Jim's Substack is also in the description. And
yes, it's just, that's the website. But if you just go Google or search Substack Hard Money Jim, you'll find my you'll find my site. You can subscribe. I don't charge for the subscription, so trying to increase knowledge here.
And also we have a comment from Bonnie, because she's a member. She says, it's time for this to make sense, and no one explains it better than Jim.
Whoa. Wow, I'm actually embarrassed with gratitude there. Thank you very much. And I'll continue to try to get better.
And we have one more super chat from Free Trade. And he says, or he asks, why is the CPI rent index so out of tune with the actual rent prices?
Okay. So for a detailed answer on that, you can look on I did an essay on this a few months ago on Substack. But in brief, here's what happens. Two things. Do I have time to answer this? I think I do. The first thing is that the way the Bureau of Labor Statistics calculates rent, most of it is done by survey, where they call up homeowners and ask the homeowners, how much do you think your house would rent for? And this is over 20% of the CPI, this what I'm describing right here. And the homeowners who don't rent their houses and have no real idea, no real way of thinking, of knowing, I don't know how much my house can rent. They just give them a number, a guess. So a substantial portion of that number is based on a survey that is based on a guess. And the second important reason is the rate at which they filter these changes in. So they do this survey every month, and they take the prices, but then they average them with the previous 5 months' prices. So what you're getting here is the last an average of the last 6 month price increases in today's number. So this number is always 6 months behind the actual price rises. So when you think about a rapidly rising market, like that chart I showed you, it is going to be way behind. And there's going to be a big lag. And so if you want some details, you can find it on my Substack page. That's a very good question.
And he also says, thanks for these shows, Jim.
Well, thank you for watching. I appreciate it.